The massive AI and semiconductor rally has suddenly paused. Where is the smart money going? We dive into the surprising shift of billions from tech giants into stable defensive stocks. For the past year, AI and semiconductor stocks have dominated headlines and portfolios. But recently, this unstoppable force hit an unexpected speed bump. Let's first remember the scale of this surge. Driven by the generative AI boom, chipmakers and key technology firms saw unprecedented, multi-100% gains. However, over the last few weeks, the momentum has vanished. We are witnessing increased volatility, sharp pullbacks, and a cooling-off period in these high-flying tech names. Our thesis today is that this isn't just random profit-taking. Instead, smart money, institutional investors managing billions, is rotationally shifting capital into much safer defensive corners of the market. What exactly does this rotation look like, and why are professionals making this move now, after riding the tech wave for so long? When we look at key indices like the SOX, which tracks semiconductors, the charts clearly show a deceleration. The steep upward curve is flattening, suggesting a temporary halt in exponential growth. The factors driving this pause are threefold. First, natural profit-taking after massive gains. Second, concerns over incredibly stretched valuations. And third, broader macroeconomic uncertainty looming. When we talk about smart money, we are referring to large institutional investors. We track their movements through indicators like large block trades and sector flow data, where the billions are moving, not just millions. So, where is all this capital, the profit taken from AI and chip stocks, being redeployed? The answer points directly to defensive sectors. The first major destination is healthcare, typically tracked by the XLV ETF. This sector provides essential, non-cyclical services, meaning demand remains stable regardless of economic downturns, offering strong cash flows and reliability. The second is consumer staples, represented by XLP. Think of companies producing everyday essentials: food, beverages, household goods. These products maintain consistent demand, making them a safe harbor during uncertainty. This shift is highly tactical. The question is, why are these sectors suddenly so attractive compared to growth stocks? The macroeconomic backdrop is key. With persistent inflation and rising interest rates, investors prioritize companies that can pass on costs and generate consistent earnings, which favors stable defensive sectors over high-growth, high-valuation tech. Defensive stocks offer characteristics that growth stocks typically lack: lower volatility, higher dividend yields for steady income, and proven resilience against economic downturns. Let's put this into perspective with some direct comparisons, looking at the recent performance divergence between these two camps. We see a stark contrast when comparing the recent chart movement of a major semiconductor giant, showing stagnation or decline, versus a pharmaceutical or staple company that is quietly pushing new highs or maintaining strong support. Specific fund flow data highlights this trend. While many top tech stocks are seeing modest outflows, major defensive names are reporting significant, sustained capital inflows, a clear sign that large institutions are positioning defensively. So what does this sector rotation mean for the broader market and your portfolio going forward? Crucially, this is a tactical shift, not necessarily a long-term bearish view on AI. It's a rebalancing, smart money locking in profits and hedging against risk, rather than abandoning the future of technology entirely. The key takeaway is that the market is now prioritizing balance and stability. High growth is being tempered by the need for defensiveness in the face of economic uncertainty. To stay ahead of market sentiment, keep watching these rotational flows. Understanding where smart money moves is crucial for successful investment strategies. Like and subscribe for more deep dives.